Let's talk about Dough's newest market announcement that we saw last week and see how things are going for this company since we last reviewed it on the channel. Long story short, I am getting slightly concerned. If you don't already know, I've made two previous videos about this company on the channel because I do find this space pretty interesting. Fintech is a space that I truly do love. If you guys are new here, my name is Fyzee and this channel is about finance and investing. Before we get into it, this video is not financial advice. I'm not a financial advisor. Please do some research on your own too. I just have a passion for investing in finance, same as you. There's also timestamps in the description. Let's jump into it. So firstly, let's have a brief look at the share price. So as we can see, if we have a look at the absolute maximum return for the share price, it's sitting in the red at negative 17%, and investors who pretty much bought at the peak of when the share launched would be sitting at a negative 75% return, which is pretty insane. And I really do feel for those investors if they're still holding on to the stock. Looking at a more recent return, the 6-month return is negative 50%, so again, not very good. Switching to the year-to-date return, and the story is pretty similar. It is negative 46%. And having a look at the year-to-date highs to the price currently, the return is also sitting at negative 70%, so it is pretty much sitting in the reds, sitting in the negative. So why has the company performed so badly? Let's have a look at some reasons why this is the case. So even though it's a pretty exciting company with big prospects if management and if the company can deliver, it is still a largely speculative and penny stock. And as of now, we don't really know if this company is actually going to make it into the future, especially with competitors coming in and other competitors that are focusing on financial wellness, like some other lending companies and companies like Afterpay if they decide to launch their banking app, and other similar companies like that. Now, if we look at Afterpay's value proposition, mostly they're trying to target millennials, which is obviously the same target market as Douugh. Douugh is trying to target more millennials and Gen Z, whereas Afterpay is mostly millennials in my opinion. Similarly, if Square decides to launch Cash App in Australia, that could also have quite negative consequences for a company like Douugh, because obviously Square is a giant in America and they can easily come into the Aussie market and pretty much do what Douugh is trying to do. So again, we do have that risk as well. Now, even though Douugh is not profitable yet, they do have quite a long runway to go and their cash position seems okay at the moment. We'll have a look at the balance sheet in just a second. Now, once again, if we have a look at the share price graph, my guess is that people who pretty much bought around that high point, if we kind of look at these points right here, maybe this point and also around this point, maybe these people have kind of decided to sell off the stock as the time goes on, because it may be the case that they've kind of moved on, they've lost their patience, so basically they're trying to sell and just kind of move on to the next hot stock and pretty much leave Douugh behind. That's just kind of my opinion. I feel like this is what could be leading to the price drop as well. So let's have a look at some recent announcements for the company, but before we do, if you have found any sort of value so far, please leave a like or subscribe. It does help out. Let's jump into it. So just a couple of weeks ago, they made an announcement talking about launching their integrated wealth management service, which is commission free. And this is of course over in the US, and basically on the news, the stock went up about 1%. Now, essentially this is just a robo-advisory service, but with a little twist. And the twist is that this wealth management service is going to be targeted towards innovation and ethical investing. So stuff like disruptive technology and companies that could define the future moving forward. And basically this is going to be managed by the investment team, and the hope is to get decent returns that could hopefully at least match the market or even potentially beat it over a medium to long term time horizon. And look, personally, I think this is pretty good because Dough's mission is not just to help you manage your income and expenses and to help you budget, but the overall goal of Douugh is to actually help you manage money to build wealth, and helping people to invest money into, manage portfolios is definitely going to help with that. People are going to be growing their money, not just leaving those funds to sit in the account and just lose their value over time with inflation. And once again, I've mentioned this in the past as well, a lot of banks out there aren't really kind of helping people to grow their wealth. They're basically offering, savings accounts with, 1% interest, 0.5% interest, and they're not really prompting people to look into investing, whereas Douugh is coming in and helping customers to actually do that. And based on a couple of screenshots, we can see that it's pretty clean. I really like the layout of this. It's very kind of minimalistic, if I can even say that. We can see that you've got goals right here for a house deposit. You've got autopilot here and some nice snapshots of your current wealth right now. Now, if we look a bit deeper into the announcement, we can also see that Douugh is planning to provide different portfolios based on different risk appetites for the customer. So you've got stuff like conservative, moderate, aggressive portfolios that people can basically choose from. And this is pretty similar to Raiz in a sense that Raiz is pretty much offering these types of portfolios, and DOU is also offering an ethical portfolio and charging a monthly fee, kind of very similar to what Raiz does at the moment. And this is pretty good because this is going to offer that predictable monthly recurring revenue to the company, which will be pretty easy for the company to kind of forecast their expenses and income moving forward. Now, one major differentiation factor that I can see for DOU as compared to what Raiz is offering is that Raiz is just for those investments and those roundups, whereas with DOU you've got investments plus other features as well, like, managing your subscriptions, looking at your expenses, AI, and other stuff like that. So DOU is more of an all-in-one type of offering. Now, one other interesting thing that I found in this announcement is the last sentence, as you guys can see. Basically what they're saying is that they're going to be gamifying the investment process. Now, based on what other competitors are doing, I think this is pretty controversial, and hear me out. So essentially, they seem to be pretty proud in kind of gamifying the process, whereas if you look at what Robinhood has done, they've been basically shunned and criticized for kind of gamifying the process when it comes to trading. Because if you guys don't know, when you invest in Robinhood, you often get kind of those gamifying features like confetti and stuff like that, whereas DOU is pretty much proudly embracing it. And the reason why it's interesting because Robinhood gamifies the process to make you trade even more, to make you essentially, treat your real life money as if it's not real money, as if it's fake money, and basically entices you to just keep on going and basically, keep on staying on that hamster wheel. However, you have DOU on the other hand, who's basically doing the same thing. They're obviously gamifying the process. However, they're taking a much more subtle approach to it. They're trying to do it with long-term investing to make the whole process a bit more cautious, if you guys get what I mean. Now, you could also argue that gamification of investments is pretty unethical because either way, people are using their real life money. It is not, play money. So you could argue it either way, but I think it's pretty interesting to see both sides of the gamification argument. If you can gamify things to make people more long-term investors and to think about the long term, whereas gamifying the process just to make people trade, which one is the better outcome, or should it not be done at all? So on the 31st of August, the company released its much anticipated full year results. And to be honest, I think the results are just okay. Not very good, not very bad, just somewhere in the middle. It's just okay in my opinion. Now, I'll get into why in just a second, but let's have a look at some high level achievements for the company so far. So the customer growth has been 151% year on year. This is pretty much the same graphics they showed us back in late April, so it's nothing new. It's not really new news. Going into the deposits, the increase has been 1,184%. Once again, all this stuff right here is not new information. They've announced this in the past, and there's a whole bunch of paragraphs, as you guys can see. Once again, we've heard this in the past, so it's not really new information. Let's jump into the company's profit and loss statement. So firstly, having a look at the revenue for the company, the whole year's revenue has been a massive $34,000, for the whole year. And to be honest, it's not really something to be excited about. However, if we look at it on a purely percentage basis, it is a 15,000% increase because previously it was about $200. But 34 grand for the whole year, to be honest, it is very little just based on dollar value. And I think what the company will need to do moving forward is to look at how they can monetize the existing customers and how they can onboard new customers. And these two are going to be the main driving factors behind the revenue moving forward. Now, they also did say that the current year income is because of transaction fees. So that's where it's come from basically. And moving forward, we do really need this number to increase quite a lot because a lot of cash has been burned, as we'll get into, as you guys can probably see based on the expenses. And speaking of the expenses, if we have a look at the loss for the company overall, it's pretty much 13x. As you guys can see, it's increased quite dramatically, and the reason for that is because of lots of one-offs for the company. As we can see based on the expenses, the $1.1 million in share-based payments, that's a once-off expense, as they mentioned. Employee expenses of 1.1 million before, and they ballooned up to $2.9 million. That's again pretty huge, and they shouldn't expect stuff like this to happen again. This is mostly due to some new staff that they hired, so that's pretty understandable. Looking at the $1.4 million in impairment expense, once again, it's pretty one-off. And having a look at the $3 million in corporate restructuring, that is mostly because of the listing for the company. So once again, that is a once-off. And lastly, having a look at the advertising and marketing expense, that's gone up from $144,000 to $1.8 million, which is again a pretty insane increase. But of course, the company has to get its word out there to acquire those customers, so that's pretty understandable. And I don't think we should see this cost go down in the next period anytime soon. So moving forward, based on what the management team has told us, we should start to see these expenses at least half in the future in the next couple of announcements. Let's see, because as they said, there have been lots of once-offs in this period. And I really hope that is the case, because a lot of these expenses is just stuff that's related to establishing the business initially, and we shouldn't see these things moving forward. And just having a look at it overall, it is much more than I expected. I definitely was expecting less expenses than this. And having a quick look at the balance sheet, this is one of the main reasons why I'm feeling a bit concerned right now. So as we can see, based on the cash position of the company, it's obviously increased. It's gone from 172 to $10.3 million. However, the company suffered a $13 million loss in the period, but the cash is only $10.3 million. So moving forward, suffering a similar size loss in the future definitely is not going to be sustainable, and the company needs to reduce those expenses and start to monetize as soon as possible. If those large overheads are not reduced, we will likely see more capital raisings in the future. Jumping into the company's cash flow statement, and we can see that the operating cash flow is negative at $7 million. And this is pretty much what I mean. A large chunk of the inflows has been from stuff like government grants and other stuff like that at about $160,000, an income tax refund which isn't really from the company itself, meaning that these inflows are not just from the actual company's activities, it is just a byproduct. And the customer portion only makes up about $41,000. So yeah, it is a bit concerning if you guys get what I mean. Let me know your thoughts on this one. So in summary, the company was only sustained by that $18 million capital raisings, as we can see, and that was pretty much the main highlight to keep the company afloat. Now, in terms of my personal opinion, if things keep on going like this, it is going to be highly unsustainable for the company. I do love the idea of Douugh, I really do. As someone who works in the banking and financial services industry, we need something like this to help out actual everyday people, and this sort of stuff is so necessary. But to make it come to life, the financials need to get better. In the next 12 to 18 months are going to be pretty interesting for the company to see what they can do to monetize their customers, bring on new customers, and see if they do another capital raising or not. Now, full disclosure, I do hold shares in the company right now. I'm not buying more, I'm not selling, I'm just holding them for the time being. But don't buy into the company just because I'm reviewing it right now or I've bought into it. Don't buy into the company because it's down, 75% from its all-time highs. Don't do that. It can always go lower. Once again, just keep in mind that it's a penny stock. If it's 9 cents right now, it could always drop down to, 6 cents, 5 cents, 4 cents, and your money could even half even more. So you want to be careful of stuff like that. Don't buy into the company just because it looks cheap, just because it's, it's fallen so much from its all-time highs. It can always go lower. Now, if you enjoyed this video, you might want to check out my other 2 videos on Douugh right here. These 2 companies basically go into the updates, the financials, and my personal opinion on the stock, and you can basically see how my opinion kind of changes throughout time. These 2 videos will be pretty helpful if you're looking to invest in the company. And guys, thank you so much for watching. Please like and subscribe, and I'll see you in the next one. Bye now. So just a couple of weeks ago, they made an announcement.